Illinois. Our guest today is Jeff French from Wiota, Iowa. He is the owner and the president of Ag Hedges. How are you, Jeff? You're welcome to join our show with us.
Doing great, Caesar. Thank you.
Let's go with the cattle quarter report on today. Could you explain the audience about this report?
It is the biannual cattle inventory report that we get twice yearly, once at the end of January and then again during the month of July. And it just recaps the number of cattle out there, but it breaks down what type of cattle as well. But the biggest numbers, what we're looking at is all cattle and calves. That came in at 98% of last year. The trade was looking for maybe a little bit more at 98.2%. So if you break it down, the number of cattle we have out there, and this is all cattle, dairy and beef, 87.1 million head. The couple bigger numbers that we were looking at specifically that affect our markets, especially on the live cattle and feeder cattle, is all cows and heifers that have calved, especially the beef herd, and that came in at 98%. So it shows that the herd expansion has not begun, and really the heifers for replacement, for beef cow replacement, came in at 99%. So it shows continued liquidation. We are in probably the 5th, 6th year of herd liquidation in this cattle cycle. And in my opinion, Caesar, what needs to happen is we need a major shift in the plains, in the Southwest, with precipitation. I think this herd rebuilding is going to be totally dependent on pasture conditions and grass. And if there's grass this spring and there's grass here next spring down in the plains, then I would expect the herd to begin to rebuild. But these numbers are definitely supportive. They were as expected. No surprises. It will be interesting to see how the market closes come tomorrow, because we did rally pretty good coming into this report. Fat cattle were up $15 to $18 in the last month, and feeders are $25 to $30 off their lows from last month. So we definitely came in here on the uptrend. The last couple of days, we've kind of tried to, we are dealing with a carryout over 2 billion bushels. And we have not seen that since that 2018, 2019 period. So it's been 4, 5, 6 years since we've had a carryout that way. Going forward, what's going to happen though, if, we've seen some baseline projections, if we plant 93 million acres of corn this spring, which I think we'll plant every bit of that, just because the fall field work and how dry we were going into the fall, this ground is going to be ready to be planted quick and early. There's going to be no tillage that needs to get done here this spring. It was all done during the perfect fall. So I look at it as, this corn is going to have to find some alternative demand, because if you put a corn crop, 93 million acres, and you put it at the size that we had here this year in that 174, 175 bushels per acre on a national level, you're quickly looking at a carryout next year over 3 billion bushels, potentially. So we need to find an area where we can, and this is just if we keep the exports the same as last year. We need to find about 600 million bushel more demand in the corn market, some from other areas. So, again, we're down here at 3-year lows on the price. But I look at it pretty simple here, Caesar. If you look at in history, every time that we've had a 2 billion bushel carryout, Historically, that would put corn futures in that $3.75 up to $4.25 price area. That doesn't mean it's going to happen here this time. I mean, we're still about 20 or 30 cents higher than that right now in the front month. But if you look at the times in the past that we've had a 2 billion bushel carryout, that's where corn tends to trade during those times. And, you got to remember, we're coming off a 3-year bull market in the grains, and we've definitely been correcting. We've really been correcting since the high back in the third week of June.
Yeah, I remember that the prices were lower for 2000.
The entire growing season ahead of us, and a lot can happen, as we all know.
How are the grain market for today's close bell in downtown Chicago?
Well, so today was the last trading day of January, the final trading day of the month. All in all, they were pretty quiet. Yesterday, they had the big reversals higher, led by the bean market. Beans were up at one point 20 cents there yesterday. All the markets, corn, wheat, and beans yesterday were outside up days. So they were in the downtrend, and they all three reversed and closed higher. The March corn actually had a key reversal higher where you make a new contract low and then close above the previous day's high. So that is a very good sign. But today, corn was up a half a cent at 4.48 in March. In December, it was down a quarter cent at 4.80 even. March soybeans were up 3.5 at 12.22 and a quarter, and November beans were up 2.5 at 11.99 and 3/4. Looking at March Chicago wheat, down 10 cents at 5.95 and a quarter. Kansas City wheat down 8 3/4 at 6.22. July Chicago wheat down 10 at 6.10 and a quarter, and Kansas City wheat down 8 at 6.15 and a half in that July contract. So a little bit of a mixed bag, very low volume day here to close out the month, Caesar.
March beans was 11.97 on Monday morning.
Yes, that was a fresh 7-month low. You got to go back to the first week of June where we traded below $12 in March. And that right now is a very significant number because what we have going down in South America right now is harvest. They've just begun their harvest up there in northern Brazil. Right now, they're only about 10% harvested. So South American, when you look at Brazil and Argentina, they're going to be harvesting soybeans for the next 3 months. And it really gets going here February, March, April. And the Chinese will strictly, most likely, be buying South American beans during those months as the Brazilian farmer harvests. So that $12 mark is very important. If we take that out, and we took it out this week, but we came back very strong there yesterday. But if we start taking it out for 2 days in a row below $12, that opens the door down to the lows back in May, which was $11.45 a bushel. So we have to absorb this South American harvest pressure. Now there's the crops right there in northern Brazil are spotty. They got very dry during their growing season, but I anticipate as harvest moves south throughout the country that the yield will continue to just be more average. It won't have these big ups and downs. So we'll see. I mean, they got close to a 6 billion bushel bean crop coming, which will directly compete with the U.S. beans here moving forward for the next 3 to 4 months.
Now that we are going to talk about the livestock market for today, how is the cattle markets for today and hogs markets?
Well, the cattle market was kind of mixed. The cattle market in the last 6 weeks has been pretty much going up every day. I mean, we're up anywhere from $15 to $18 in the fat cattle. and we're up $25 to $30 in the feeder cattle during the last 5 to 6 weeks. I mean, we all know that horrible sell-off that we had. Seasonally, this is the time that we typically do rally in the cattle market. Again, going back to the cattle inventory numbers, we'll see. There was no major surprises, nothing too bullish, nothing too bearish. So we'll have to see if these numbers are already into the mix here. But if you look at the hog market we talked about, I mean, the hogs have closed up. I think it's 16 of the last 19 days they've closed higher. You have July hogs trading 40% higher than the CME lean index right now, lean Honda index. So there is some tremendous premium out there in those summer months. They're trading right below $100, 97, 98 cents per hundredweight. So when I see that big deferred rally, I can't help but tell my hog producers to start looking at some downside protection, because this has been an awfully good rally. I know this market has been beat up here for the last year and a half, but we just rallied here the last month strong. Most contracts up anywhere from $10 to $15 a hundred. So obviously the funds were buying it up into the end of the month. A close higher on February 1st tomorrow will look extremely strong as well.
Do you have any final thoughts on the markets, Jeff?
Well, I think, moving forward, I mean, near term, in the next 3 to 4 months, it will be dominated by the South American bean harvest, how that progresses. And then also right behind the bean harvester, they go and plant their corn crop. So if it remains hot and dry, this corn crop could be in trouble down there. And that would make us pretty much the only game in town for export. So by all means, down here at 3-year lows, I don't want to get too much more bearish, because at these prices, we could quickly pick up some export demand, especially if there are problems in other growing regions. You look past that, I just think here in the next, 12 to 18 months, it's going to be very interesting how this artificial intelligence, when they continue to start to incorporate these big funds, incorporate that into their marketing and trading programs, how that's going to affect these markets. So I just think we're going to have extremely volatile markets here moving forward. It's going to be imperative with these price levels to have a plan in place and execute that plan when and with these prices do rally. Because I've been doing this a long time. Yes, corn prices might be under the cost of production right now, but typically every year the market will give you an opportunity to sell that crop at a profitable level. Now, it only might be 1 or 2 days, but the market will rally to a price where it is profitable. So you have to have your targets in, and you got to execute your plan.
Thanks, Jeff. My pleasure that you joined the show for today. Thanks. You're welcome to join the show anytime.
Thank you for having me, Caesar. Have me back anytime. Thank you.
This is Jeff French from Wiota, Iowa, for Ag Hedges from Back Roads of Illinois. I am Caesar Delgado. Have a great day.